Hello, and welcome to the June Market Navigator update from Oak Capital. It's been a busy month filled with meaningful updates, news, and headlines, and notably a departure from the sell in May and go away pattern of years in the past. I'm Michael Cochran, and I'm glad you're with me today as we walk through the recent market activity and what we're watching in the months ahead. Equity markets have continued to move higher in recent weeks, with the S&P 500 approaching record levels after a rare 9-week winning streak supported by strong AI-driven earnings and optimism around a potential agreement with Iran. While their broader backdrop remains relatively constructive, valuations are elevated by most traditional measures, and oil prices remain near $100 as passage through the Strait of Hormuz remains restricted. This naturally raises the question whether markets are pricing in too much good news. In thinking through that question, we place less emphasis on valuation as a short-term timing tool. Metrics like the price-to-earnings ratio can help frame longer-term return expectations and downside risk, but they have historically been less useful in predicting near-term market moves. S&P 500's valuation near 21 times earnings can be supported by solid earnings growth and a resilient U.S. economy, though further market gains will likely depend on continued stability in key areas such as inflation and interest rates. Without improvement in those inputs, returns in the second half of the year may be more modest and potentially come with some more volatility. Against this backdrop, AI remains a central driver. Large technology companies, particularly the hyperscalers, continue to deliver strong earnings growth even as questions remain around the scale of investment and the timing of returns. Recent results point to accelerating demand for computing capacity and continued expansion in capital spending. In fact, investments tied to AI is expected to exceed $750 billion this year and has already grown significantly since the start of 2026. Moves in semiconductors and hardware companies suggest the market may still be underappreciating the magnitude of this build-out. While valuations at the index level appear elevated and some areas of the market show signs of excess, parts of the technology sector may still offer attractive opportunities relative to their growth potential. There remains a healthy degree of skepticism around the productivity gains AI can deliver, which leaves room for upside if those begin to materialize more clearly. At the same time, heavy capital spending has weighed on free cash flow, which adds risk if expected benefits take longer to emerge. Looking ahead, market performance will likely hinge on the balance between valuations and earnings growth. With limited room for further multiple expansion, the focus shifts to whether companies can continue to deliver on earnings expectations. AI remains a powerful tailwind for both economic activity and corporate profitability, and over time it has the potential to drive meaningful productivity gains. While near-term expectations may be running ahead of reality, the combination of innovation, resilient fundamentals, and the potential for easing geopolitical tensions supports a constructive long-term outlook for investors who remain disciplined and diversified. With summer approaching, we want you to know we're still here and available to connect in whatever way works best for you, whether that's by email, phone, video, or in person. Please also be on the lookout for additional blog posts and videos in the months ahead as we continue to share updates and insights. Thank you.